Welcome everybody. Tonight I'm going to dig a bit deeper into stop losses, the discipline of stop losses, and the premise of what I'm going to talk about is predominantly to make sure you have the right amount of risk in the current market setup that is relative to your own individual risk appetite. What do I mean by that? Size of position within the market structure, as in bids, offers, support, resistance, etc., and the potential move in your profit and loss relative to your bank account to make it easier. If I just look at this here and I say don't fall into this trap, maybe this resonates with a few people, and it's something that happens very, very often. Typical trade idea: I want to be long of euro versus the dollar. I just decide to buy at 104.45. I know I seldom pick the bottom, but I want to get involved anyway. And I just automatically jump into my default position. In this instance, it's 100,000 euros. So the market moves against me, as it will. And 40 points lower at 104.05, I currently have an unrealized loss of around $400. And I don't like that. It's not a number I'm comfortable with. And it really starts me thinking and worrying about it. And while I'm worrying about it and not actually doing anything about it, it moves further against me. It moves another 46. By now, the emotions are high. I've still done nothing about it. I'm still holding that risk. And I'm now roughly $800 underwater. And this is where I start making rash decisions because I've done no planning at all. And, I'm actually really unsure what to do. And the next move down, albeit small, down to 103.59, probably forces me out because I'm coming closer to $1,000 in loss. And I really can't take it anymore. And I just press that button. And lo and behold, as we all think when we get stop lossed out, the market rallies up to 106. And, what's even worse is potentially afterwards I may speak to, on a forum or chat to fellow friends, post-trade, and they start talking about, the resistance down there at 103.40 held really, really well. And at that point, I either think I didn't know anything about a support level, or if I did, I forgot about it because I was panicking in selling out. And so what happened is I had a lack of discipline in that situation. It caused me to make an unnecessary trade, and I took my loss before the market rallied back into a situation where I could have been starting to take profit. So can this happen to me? Well, this is just a setup that actually did happen in euro dollar, and we can see from all the price action here, we had highs at 105.07. I basically was trying to buy into a fade. I get that fear factor when I get down to 104.05, and people say, well, no, I wouldn't have been panicking. Well, look, that 104.05 was on a big red downward candle, and I definitely would have been panicking a little bit there, and particularly as it started moving down. And there's every chance I might have sold out. And as we see, albeit it didn't rally immediately, and of course I could have got back in, it's now rallied up to 106, the figure, and I could have been smiling at that point, in which case, I would have held in, but there's a good chance I got myself stopped out in this situation. So how can I address this? Well, if we just roll this one out, one of the key things we always talk about is planning and preparation. So whenever we have this trade idea, and even if it's an instinctive trade idea and I'm an intraday trader, I should still do this little bit of homework and know the previous price action, i.e. the market setup that I spoke about, prior to getting involved in a marketplace. Because as and when the market moves to some of these critical levels, I should be aware of it and be able to make a more informed decision around that information. So what would I glean from just a quick glimpse at this chart? Well, I would have seen that support down there at 103.50. And actually, if I'd have gone even further back down to 2017, 103.40 was a low. So that's serious information. And if I'd have had that information, I may have been able to hold myself in. But the losses were getting too big, and that was my problem in that example that I gave. There's other small lows down there at 103.85, etc. And we need all that information to help us trade. And equally on the top side, if we're going long, we want target levels as to where we may take profit. So we need to find out where the resistance levels may be, where the market may slow as it approaches those levels, and where potentially our best opportunity may be to sell out. And some of our real ambitions up there at 107, high 107s. So that gives us a great amount of information. What's the next thing we need to do? We need to work out what our risk appetite is. So we've done market setup. Now we're going to work out the size of our position. And first of all, we have to find out what our risk appetite is. This simple calculation, if by example we had a $20,000 capital account, we work out on this particular trade or any given trade, we don't want to lose more than 2% of that. Funnily enough, that relates to our $400. So we've got this maximum loss level that we want to put on our trade, and that will actually help us in defining the size of position that we put into the market. So if we go back to the chart, we're going to actually see this situation roll out. If we buy at 104.45 and we dive straight in with our 100,000 euro size, which is our default size, where is our stop loss? Well, we know the big support level is down there at 103.40. So we put our stop loss a little bit below a support line and a little bit above a resistance line, just to be smart, because everyone's going to be targeting these. And what we actually do then is work out, wow, if I had a 100,000 euro position, I get stopped out there. That's going to cost me $1,150. I only have risk appetite for $400, so something's wrong here. Now, here's what lots of traders do. They want to stick with their euro $100,000 position because they think it's big and they want this nice size in the market. So what they actually do is they put their stop loss at a point where they only lose $400. And as we see here, that will be at 104.05. And if we all remember that number, that's where we first started thinking about losing money. And when we see this line come across, all of a sudden we'll realize that that stop loss is in no man's land if we look at previous price action. And so although I'm only losing $400, I'm going to be stopped out in no man's land, and it's absolutely pointless putting my stop loss there. So what I should be doing is putting it in at the right level, and by then I calculate, well, if I only want to lose $400 and I'm opening up my position at 104.45, I'm going to lose 115 ticks. So what is the size of position I need so that if I get stopped out, I only lose my $400? And as we see the calculation is there, I should be going into this trade with just 35,000 euro dollar position at 104.45. If unfortunately I get stopped out, I know I've been stopped out at the right level, because if the market goes through there, it's a significant support level, and I should be happy that I'm out. The key thing here is I stay in this trade. Would I rather have a $100,000 position and get kicked out for a $400 loss, or would I rather have a smaller position that survives the run down towards the stop losses and I'm able to own something on the way up? I'd rather the latter, clearly, because then I can start thinking about my take profit strategies, introducing trailing stops, etc., to protect the intrinsic value in my trade as it goes in my favor. And so I'm happy. And although I've got a smaller position, I've got a profitable position, and now I can start enjoying thinking about my strategy as far as selling out at a nice profit. Hopefully that helps you, and I'll see you on another webinar.